Hello everyone, my name is Ashlyn.
And my name is Tanner.
Today we're going to explain the economic significance of the merger between DuPont Pioneer and Dow Chemicals and the acquisition of Monsanto by Bayer. DuPont Pioneer, Dow, Monsanto, and Bayer are chemical seed companies that have an overwhelming presence in the North American agriculture industry. Dow, DuPont Pioneer, and Monsanto all have influential products for the corn and soybean seed and chemical market, whereas Bayer and Monsanto have a bigger influence in the cotton and canola seed and chemical market. For the Dow-DuPont Pioneer merger, they will be forming 3 new independent, publicly traded companies. One will focus on the agriculture products, another will be a material science company, and the last one will be a specialty products company. In the case of Monsanto and Bayer, Bayer acquired Monsanto for a bid of $66 billion. It was speculated that due to Europe's GMO restrictions, that Bayer would be better served investing its money in the North American market, in which Monsanto is one of the very first pioneers of biotechnology research and development. Why do mergers happen? Companies are looking to expand their intellectual property, vertically integrating new ideas, and branding out the company. Vertical integration allows the company acquiring or merging to protect themselves from competition while increasing dominance in the market. A merge can increase the company's economies of scale by reducing the cost per unit by increasing the amount of product that is produced. This happens when a company gets bigger and needs more units to fill out consumer demand. A merger or acquisition also can affect economies of scope because the company in question will be able to reduce their average cost by adding more products to sell.
For the underlying economics of this article, we will cover such topics as changes in market concentration, as well as changes in contestability, barriers to entry, and market structure. The first topic that we will address will be market concentration. In the table provided in this slide, we look at changes in the seed and chemical market over a 19-year period. For agriculture chemicals, we can see the foreign firm concentration ratios increasing from 29% of the market in 1994 to 62% in 2013. For crop seed and biotechnology, we see an increase from 21% to 58% over the 19-year period. As we dive deeper into these numbers, we can derive each company's market share for each respective crop. DuPont Pioneer and Dow currently have similar market share in corn and soybean seed at 34.5% and 6% respectively in corn, and 33.2% and 5.2% respectively in soybeans. This merger would give DuPont Pioneer and Dow a combined 41% share of the market for corn seed and 38% share of the market for soybean seed. In the seed market for cotton, Monsanto and Bayer hold 31.2% and 38.5% market share, respectively, and the proposed merger would give Monsanto-Bayer about 70% market share. As these companies merge and expand their market share, they will have more control over price within the market, causing a convergence to a uniform amount. After the mergers and acquisitions are finalized, these percentages will be spread between fewer firms, resulting in higher market share occupied by individual firms. These changes have resulted in some skepticism regarding the adherence of antitrust laws. The second topic we will cover is market contestability and barriers to entry. For there to be market contestability, there has to be freedom of entry and exit as well as little to no sunk costs. Sunk costs cannot be recovered once incurred. In this industry, they would include regulatory expenditures on advertising and expenditures on research and development. Investments in this market are often risky, expensive, and long-term. Intellectual property protection helps inventors exercise market power and prevents any imitators and competitors. The high costs of developing such products creates high barriers to entry for smaller firms. With the changes in market concentration, current market contestability and barriers to entry, we can look at market structure. The current market structure is that of an oligopoly, a form of imperfect competition characterized by a few large firms present, non-price competition, barriers to entry, and product differentiation. Most firms who participate in a form of imperfect competition have specific methods of operation when it comes to revenues, costs, and profits. Oligopolies do not use market demand curves, and their downward sloping demand line is also their price line and average revenue line. The marginal revenue curve will always be twice as deep as the demand curve. The firm will always produce at a profit maximizing level of output where marginal revenue equals marginal cost. From there, a firm will derive its price from that particular output point, connecting it with the demand curve. After the firm has derived their price, they can project their revenues, costs, and profit. This figure shows the cross-licensing agreements between the four companies, as well as two other key players that are not involved in these mergers or acquisitions. These arrangements of cross-licensing can also be referred to as non-merger mergers, as there is no change in ownership. The figure raises an important question of the firms practicing cartel-like behavior, a form of collusion that allows the firms to retain market dominance. Most oligopolies produce according to what their competitors produce, also called the Cournot level. However, this form of cross-licensing forces small competitors to either merge with the Big Six, to license from them, or to go out of business.
So how does this all relate to agriculture? Well, relative to Saskatchewan, Bayer's acquisition of Monsanto has created some skepticism among canola growers. Saskatchewan is one of the largest producers of canola in the world. Bayer and Monsanto together hold at least 70% of the market share, and in the canola seed business, and 95% of the herbicide-tolerated canola trait business. Bayer's acquisition of Monsanto will create the biggest player in the biotech cotton industry. Post-merger will increase their share to 70%. This poses a threat to the costs of cotton farmers' inputs, specifically the farmers in Alabama who heavily produce cotton in the United States. The second implication created by the merger and acquisition is that the prices for seed and chemical will increase. They have continued to increase over the recent years because of the continuous mergers from other smaller private biotech firms. The firms that make up the Big Six include Monsanto, Syngenta, DuPont, Dow, BASF, and Bayer. These firms have the power to control their biotechnology and to block its usage by other firms, therefore protecting their intellectual property. With the diminishing ability to save seeds, prices increased over 30% annually in recent years, affecting the agriculture market more than inflation. Combined with the increase in chemical prices that complement seeds with herbicide tolerance, a farmer's break-even point could rise substantially, affecting their bottom line. Since these companies had competing products prior to the merger or acquisition, there will be a loss of product differentiation post-merger. This will result in a loss of competitive pricing. To sum it all up, the commodities that are at risk the most when it comes to a price increase of seed and chemical inputs are cotton and canola, because 70% of the market share will be controlled by Bayer and Monsanto after the acquisition has been final.